Hey everyone, welcome to another episode of the Third Estate Podcast. I'm your host, AJ Abarca, along with my partner, Antone, where we discuss anything finance and whatever else comes to mind. With us today, we have David Packham, CEO of Chintai, to discuss the application of blockchain in today's world. David, why don't you just tell the audience a bit about yourself?
Thanks very much, AJ. My name's David Packham, right? I'm the CEO, founder of Chintais. We are a digital asset company that are aiming to bring regulatory compliance to this space, and I'm sure we'll delve more into that in the next coming hour. In terms of my background, though, I have a 20-year career in financial services. I started out my career with Accenture, which was one of the larger management consultancy firms, and then moved to Merrill Lynch into securities lending earlier in my career. After that, I moved across into Credit Suisse and then Goldman Sachs. And I was actually at Goldman during the financial crisis, the period of the Big Short, and got to see from the inside myself how, I suppose, really we started to work out that all these cool instruments we were working on actually were not necessarily understood by anybody. Everyone, I think, had been operating with this view that the world was just run by very smart people, and these instruments that maybe we didn't understand individually must be understood somewhere. And I think that's something, incidentally, we are seeing in the DeFi space, which we'll touch on later as well. But there's always a mass assumption across systems that somebody somewhere understands these things, even if you don't yourself. That's not always the case. And that led to me having a bit of a fundamental reevaluation of what I was doing in life. I think most of us who want to get fulfillment in our careers and in life, they need to work on things they have a passion for and feel you're adding value to the world, to feel genuinely enthused and energized. And I certainly found myself really reevaluating what I was doing with my life at that point. I was in my probably early 30s at that point, roughly, and I'd spent over a decade in finance, and I was no longer happy with what I was doing with my life. And that's what led me to go on an entrepreneurial path. I set up an initial business and exited that. But around about 2016, I then started exploring this idea of leveraging blockchain technology, also known as distributed ledger technology, DLT, to find ways of potentially bettering the global financial system. And that's what led me down the rabbit hole of going into the whole crypto space, and subsequently from that, the formation of Chintai as a project and a platform.
That's awesome. Well, you have a great story. And I mean, David, I've obviously let you know, I love that you have the ability to offer that perspective from traditional finance and going into the crypto and blockchain space. I mean, you touched lightly on it a bit, but I'm curious, was there anything specific really of why you decide to make that transition from a traditional financial career over into crypto and blockchain technology?
Yeah, definitely. I had spent a lot of time arguing with people who were very, very cynical of banks and other large institutions. Around the time the financial crash happened, I was absolutely adamant, look, this is all down to the government. And, it's not the bank's fault, and they've really done nothing wrong, was my initial take on this. And so it's a great example of not being, of people making assumptions not really based on full level of information, because as more information came out about how, for example, collateralized debt obligations, these CDO squared products had actually been derived and designed. This is the packaging up, for those not familiar, of junk bonds and other kinds of debt that were basically pumping the housing market and global debt. And then they were being recategorized from junk status to AAA in a completely unsustainable fashion that led to an entire collapse of the system and led to systemic damage. It led to widespread large amounts of debt. And what it ultimately led to was the bailing out of large numbers of financial institutions, banks, and they didn't really, anybody in the industry, pay a particularly much of a penalty to this at all. And so, if you look back at that, that was what really led me down this rabbit hole of really reassessing everything that I had previously based my assumptions upon. And from that, I was able to realize that, this is actually not what I thought it was at all. This is not what I want to be a part of. And I actually want to find solutions that stop the industry from negatively contributing to the world, and actually we can align interests far more positively. Yeah.
Interesting. So, I mean, I'm curious, when you started to enter this space, were you coming with just your, I guess, like business development, operational, financial background, or doing how some individuals start learning like software development and some of the technical aspect of the blockchain technology?
Well, yeah, we haven't. Yeah,
I'm just curious where you come into line.
We haven't really talked about what I did in banking, actually, and finance. And I work for asset managers and wealth managers too. And I started off on the tech side, actually. So I was a VB and Java developer at the start of my career. Not a very good one, incidentally. I mean, I wasn't terrible, but I was not naturally talented to say out that. Where I actually had more strength was communicating with the business, and I moved across to the business side over the next sort of 5 years of my career. So I have quite a good understanding of the software lifecycle, development lifecycle. I've done waterfall projects for those in the tech area, and I've done agile. And so I have a decent understanding also of how technical development can become fundamentally misaligned from what the business needs. And that was one side of my career that stood me in good stead in terms of coming into blockchain generally, because I've always seen it as an enabler, as a new form of technology that can be applied, but it needs to be applied properly, and it needs to be applied in a structured way to actually add value. And what we've seen across the industry with most of the early projects is frankly they haven't really been structured in any way at all. They just sort of deployed out. So I went down the rabbit hole of crypto and completely bypassed Bitcoin. I took a look at it early on. It didn't really interest me that much. And then I took a look at it later in 2016, and when I had exited a business I'd been running for 5 years prior, and that's what really sparked my interest was actually Ethereum, because Ethereum had an incredible concept I'd never considered, which was this idea of the decentralized application, which is i.e. you can run a virtual machine on top of a blockchain and actually operate entire application on this structure. That was for me an absolutely fundamental moment, and I deep dived into the Ethereum platform, learning Solidity at a basic level, trying out deploying some Hello World smart contracts, and then I realized this thing could handle about 13 transactions a second and was already incredibly expensive to use, and it was kind of okay, so nice concept, absolutely hideous for the needs of industry. This thing, because I came from a background at that point where I'd been working on high performance order management and portfolio management trading systems and implementing those for banks too. So I was very aware of the idea at that point that we could leverage this technology to put an entire order management system onto a blockchain. And as I was very familiar with the inefficiencies within the system, where you've got silos of banks replicating the same model over and over, they've got different sets of data. You've got thousands of white-collar jobs globally whose entire job is to basically manage the inefficiencies of this process and try and match everything up. You could see instantly that you could move to a vastly more efficient system and design. But obviously, I hadn't yet found a technology that was scalable. And that's what led me down another rabbit hole, which was to find another blockchain protocol that was launching pretty soon after that in 2017. And I went and started following that more closely, really with an aim of leveraging that to deploy an on-chain trading system first time and see where that led as a potential.
Interesting. So is it safe to assume that were you trading Ethereum and stuff like that when we were seeing these massive pumps and like the end of, I think it was 2017 until the decline of early 2018? Or was it really just the application and the use case of the technology that interested you?
Yeah, no, I took some exposure. The problem is I didn't sell at the top. So there we go. Mm-hmm. You live and learn with those things. I gloriously held my gains and then went back down the other side again. But that's more because I was far more interested in the application of the technology anyway. And I was very involved at that point in the launch of another public blockchain called EOS at that point, which had an interesting journey in its own sense. At one time, it was being branded the Ethereum killer. And what's actually turned out to happen is that it's probably arguably underachieved in terms of that potential to a large degree. A lot of that actually comes down to network effects and an investment in the ecosystem, actually, rather than the underlying tech, which is definitely far better suited for deploying applications and particularly for enterprise and industry. But that's an important part of the maturing of the sector in general, I think. So I was very focused on that. And while the crypto winter took place, Chintai had already formed as a platform and as a project, and we deployed an initial version of this engine out. And it was for a very niche use case called token leasing, which, without going into specifics, enabled the utility of tokens, can be how they're utilized in different ways. In this case, it was network capacity on this public blockchain to be traded and for passive income to be paid back in return. Classic leasing in that regard. So we built that out, did about $250 million of trade volume in the first 3 months, and then the whole use case largely went all the way. So it was a good early formative example of how I think startups in general, particularly entrepreneurs, need to be prepared to pivot. They need to be able to step back and analyze what's necessarily works, what's sustainable, and what isn't. And that's exactly what we did. We spent the crypto winter building out a much broader concept to actually deliver instead a comprehensive digital asset platform that handled dynamic forms of issuance, secondary market deployment, and all of that operating on a compliance control framework that could really enable financial services to properly use a solution for the first time and further mass adoption of this technology. That's been the broad aim ever since the crypto winter sort of kicked off in about January 2019.
Yeah. And I mean, it's interesting you mentioned utility because I'm not sure if you've heard, we actually had a previous podcast episode where Antone and myself, with a guest, were talking about Bitcoin specifically and the trading of cryptocurrencies, right? It wasn't until, I will fully admit, recently that I've actually dived a bit deeper into the fact that there are different protocols and uses for the coins. Bitcoin is really kind of termed that idea of being a store of value similar to Dogecoin, but then you have other tokens or crypto assets like Ethereum and such that provide some sort of utility. So I'm curious of just, do you mind explaining or just educating our audience a bit more of the different types of main use cases that we've seen in the crypto space?
Yeah, for sure. And I mean, the underlying protocols themselves operate on quite radically different premises too. So for those not familiar, proof of work is the first decentralized ledger technology protocol that Satoshi Nakamoto proposed, and it was really an evolution of some cash and other e-money types of experiments that have been run in the decade prior. And it relates to the utilization of computational power to effectively guarantee network security. It's a very clever design. Unfortunately, it also does utilize increasing amounts of power, which further strengthens the network in terms of its ability to be effectively hacked by something called a 51% network attack in terms of being able to rewrite the blockchain. So its immutability, its ability to be trusted as a source of truth across all the network participants without anybody in the center having to verify is extremely strong. And as a proven use case for that, Bitcoin has, I think, really proven the design very, very well. What it's not really particularly well designed to do is scale, at least on itself, on its own terms, and be utilized as a currency in any form. It can be used as some form of a store of value for sure. I don't think anybody can really look at the value of Bitcoin now and not argue that there is enough consensus globally that this thing has value. It's just the open question remains, what is its value and why? But outside of that, there are other types of blockchain protocols. Proof of stake is another one, and that's the one that Ethereum is gradually going to be migrating to hopefully solve some of its scaling issues. That really operates on the value or on the premise that those people who are validating the underlying network itself, i.e. the blocks and the transactions taking place, they have to put down a large stake of the underlying network token. So in this case, ETH for Ethereum. and they stand to lose that should they obviously misbehave. So there's a big financial penalty and incentive for being caught out trying to carry out fraudulent activity. That's the underlying premise of proof of stake. And then there's other forms of protocol too, and there are lots of them actually that are coming out, trying new experiments. But the other most popular one is delegated proof of stake. And what that really relies on is the fact that the validators themselves do not need to hold the stake itself, but the network participants can effectively vote almost in forms of a continuous election for the block producers to manage the network. And delegated proof of stake also has its own flaws. They all tend arguably towards centralization in different ways over time. And I suppose we see that in institutions across the world and all sorts of power structures. So perhaps we shouldn't be too shocked by that. I mean, if you look at the global financial system, as you get to a certain level of wealth, it gets increasingly easy for you to make more and more money. And you can see that in the very kind of almost like the gravity of money itself as well. And the same seems to apply with even these decentralized structures too, whereby power gradually becomes more and more concentrated to some degree. And that's one of the governance kind of experiments that I think we're still seeing in crypto, which is how do we truly see a decentralization of power and governance of these networks as well? And that's probably the big challenge ahead. But one of the big advantages of DPoS, though, as a protocol is that it's extremely scalable. It rather than be able to handle, Bitcoin's, I think, between 7 and 10 transactions per second, and Ethereum is currently 10 to 13, I believe. You're looking at the EOS.IO protocol being able to handle 5, 10, 20,000 transactions per second, and it can integrate with other chains and scale up potentially infinitely. And that is very powerful when you're looking at the use case of applying this to industry, because industry don't care about this level of decentralization. They see it more as a spectrum. They're interested in leveraging the efficiency gains of DLT. But what they're not necessarily interested in, particularly at this stage, is trying to operate all the financial system on a completely public blockchain. And actually, when you start to examine things like regulatory compliance, there's a lot of very good reasons why it's not particularly fit for purpose as a design anyway, because you've got that immutability, which means you can't actually undo criminal and illegal activity either, which really therefore doesn't lend public blockchains particularly well for regulated DeFi. Well,
David, you mentioned earlier, and then you just now mentioned it again, the barrier of blockchain and crypto to making the financial industry more efficient. Because AJ and I have had this conversation multiple times of whether it is crypto and blockchain or other technologies, it seems like the financial industry is always a little bit behind in implementing any kind of new technology and I think a lot of that has to do with the regulatory aspects and compliance. But what is it, I guess my question is, what is it that you've seen that is a little bit more specific to why that is so? Like, why is it that it takes just those extra years to implement something that maybe other industries are able to
adopt at a faster rate?
Yeah, adopt at a faster rate. Like, is it because of the testing? Is it what is it in your experience that makes that happen?
It's a very good question. I think one of the big misconceptions externally outside our industry, I mean, you guys are from the financial industry too, so you probably appreciate this well. One misconception is that there's not deep technical expertise in financial services, and that couldn't be further from the case. It's a highly innovative area with some of the best technicians you'll ever meet, and partly that's because it pays well as an industry, so it's able to attract that talent. But if you look at the history of the financial system, it's been innovators creating either innovative new products or financial systems around those to actually support those products, bespoke completely from the ground up. They've created their own tech to support that. So if you actually look at the history of kind of blockchain, it really hit the radar of the financial services industry meaningfully in the last crypto boom at the back end of 2017 onwards, because that was when it got really the whole world's attention. I mean, there was this enormous bubble that formed, and the returns were outrageous. But at that point, internally, the banks for the first time started to realize, hang on a second, this technology is applicable in our industry in definitely in some form here. We can actually utilize this technology. And if you just take a step back and look at our architecture, it's a mess. But if you were to apply even just blockchains in localized regions across the trade life cycle, we could make huge efficiency gains. But if we actually had the entire industry operating on, say, a single chain, well, the efficiency gains are just enormous here, and suddenly whole concepts like settlement and clearance become obsolete. And the idea of the middle and back office, which for those not familiar, these are the guys doing jobs which are simply reconciling trades and making sure they match with a counterparty on the other side, half of that could disappear. And nothing incentivizes banks more than the opportunity to fire people and save a load of money. So what's actually happened subsequently, though, is that just as they started to get really interested, we saw a massive crackdown by the authorities on the ICO boom, which is, for those not familiar, the initial coin offerings were these effectively they were unlicensed securities offerings taking place during this 2017-18 boom, where companies were raising vast amounts of money, issuing in many cases what was effectively a form of security without any licensing. And what was good about that is it showed why there were rules in place in the existing industry, because we saw mass fraud, mass misrepresentation, exit scams, retail investors acting, in a very irresponsible way and mortgaging their houses and losing vast amounts of money. It was a wonderful example of why there were some rules and controls in the existing system for me. It showed that, you can sit there and be a crypto anarchist all you like, but actually if you let the entire market operate without any kind of rules or regulations, you're going to see criminal activity and it's going to run rampant. And so just going back to my original point, the reason, therefore, we've seen this delay, to Antone's point, is that that really scared the banks off touching this technology in a meaningful way. They continued internal experimentation, and they've been doing that for a number of years since. And there is some deep expertise in-house with many of the largest financial firms now. They have digital asset teams. They have strategic investment teams that sit alongside them. They are looking to leverage this technology, sure. And they are looking to, I think, leverage tokenization and the potential of that to create new asset classes or disrupt fundamentally existing ones, real estate being a really big example of that. And it's all coming. So to the final question that you asked, why is it taken them arguably longer than, say, some other sectors where we're seeing blockchain becoming adopted slightly more rapidly? Examples of that would probably be things like the gaming sector and NFTs. Well, the reason is that they're not regulated. Whereas you've got a security, for example, you can't mess around and risk your own financial licensing and your established reputation and so on. You've got to be much more cautious. And so really what they've been waiting for, the global institutions, is a series of solutions that actually are fit for purpose, have been designed from the ground up to enable them to actually experiment with this technology, prove the concepts internally, and then when feeling secure about it, actually start to launch these types of marketplaces. And I think that's the point we're at now. I think we are seeing the first solutions fit for purpose that have been designed from the ground up to meet their needs. And I think we're going to see mass adoption now over the next 2 to 3 years, really kicking in across the global financial.
Yeah, and kind of, I want to segue there with your idea that we're going to start seeing increased integration in these different applications. What are your thoughts then in regards to the coexistence between the traditional assets that we have, right, in regards to equity, public stocks, bonds, what have you, and those crypto assets that we're seeing? And are you at all, you mentioned earlier about the ICOs, are you at all fearful? Because we are still seeing ICOs coming out for a lot of coins that, in my mind, my perspective at least, they don't really serve any sort of value, right? I think there's like Eno, and so you can just create a coin in an hour or so and release it. It kind of reminds me a bit of, the .com bubble, where if you had a .com at the end of your company name and you just tried to issue out a security back in the day, entering that kind of era. So I guess it's a two-part question on the integration of the two asset classes, and what are your thoughts of possibly a .com bubble 2.0 or internet 2.0 bubble?
Yeah, in terms of the integration of the the two asset classes. I think that's been really well illustrated by the likes of Binance, and there's another network called Terra, which has something called the Mirror Protocol. They've come up, and it's become very popular in the last probably the last 6 months. This concept of something called stock token. Now, what does that actually mean? It means that the underlying token is one-to-one backed with a security in a traded and licensed security. So, for example, you've got Binance started listing and you were able to trade Tesla tokens that were one-to-one backed with Tesla shares, and they did this for a multitude of others. As soon as I saw that, I thought it's only a matter of time until the regulators shut this down, because this is effectively an unlicensed. You can either call it some form of security derivative, but it's something that is definitely unlicensed and is bypassing all the controls and rules around who can be valid participants in a given marketplace. It's effectively also a fantastic tool to enable, should we say, the criminal underworld to be able to invest in public securities without any controls around them. And I suppose, therefore, if you look at that question about this intersection between digital assets and we'll call them traditional assets, there are enormous benefits from the move towards digital. And we can touch on how some of that innovation is possible. But the single biggest thing for those not familiar is that tokenization doesn't just enable the representation of an asset as a digital unit, because that can be done, you can argue right now, with securities now. What it does, though, is it enables you to be able to firstly lower the cost of that issuance process and the trading process, but it also enables the encoding of different types of properties into that at the smart contract level. And what that means is you can embed and automate all types of things like corporate actions, and indeed you can innovate and add all types of new behaviors, a lot of which have not even been thought of yet, so that you can create a completely custom asset. Now, this is quite hard for people to get their heads around, because we're into completely uncharted territory here, but we're actually going to enter a period of innovation when we hit this, whereby you're going to see financial institutions really coming up with dynamic forms of assets that almost have properties that are a bit securities-like, maybe a bit bond-like, maybe they've got insurance-related components in them. They can have all manner of different things almost embedded within them as a kind of bespoke package that investors kind of get exposure to. And that will enable aspects like adding additional levels of protection to downside risk, for example. You could have corporate actions that are auto-enforced within there as well. And so to kind of go back to it, I think what we're going to see over time is although we've seen this experimentation with stock tokens, is that we are going to see an increasing move towards traditional assets effectively migrating to becoming digital over time. But what we need for that to actually take place is that it needs to operate in a regulatory compliance control framework of some sort. So in other words, it needs to utilize the blockchain technology, but in a way that enables compliance to be fully enforced. And one of the biggest examples of that is the ability to, say, segregate markets and decide who's a valid market participant or not. So you can't have a scenario where you can just, issue a Tesla token and then send it off to Kim over in North Korea and say, here you go, you can buy as much Tesla stock as you like, when they're in the global financial system. North Korea is a restricted jurisdiction. Now, that's the problem with trying to utilize public blockchains. There are certainly rumors that many of these kind of restricted countries are big investors in the public blockchain token space, because it gives them a means to actually effectively participate in the wider financial system, whereby they're restricted elsewhere for good reason. And so we're going to see that side of things for sure. And I think, what was the second question you asked?
In regards to your thoughts of a .com or Internet 2.0 bubble.
The bubble side. I think what we're seeing with regards to a lot of the tokens being issued, I completely agree with you. What we're seeing there actually really represents the ICO thing all over again in one sense, which is, if you give people an opportunity to try and make a quick buck and pump and dump and exit, you'll find people all over the world who will have no qualms about doing that directly at the expense of others. I mean, I personally find it fairly abhorrent, because what you're doing is you're not really creating wealth or value in the world. what you're actually doing is a direct transference of wealth from one group of people to yourself. And I saw that, in the financial system at its worst back in 2008, 9, 10. So it's never something that's particularly interested me. And the reason that happens, though, is what you really mentioned, which is you couldn't see any underlying point or utility to some of these tokens. And you're right. In many cases, take the Shiba coin, which is nothing more than another mirroring example. It's another puppy coin, right? It's Dogecoin too, cashing in on that, and it's got billions and billions of dollars of current valuation on traded on the market. But it adds absolutely nothing new, because if it's just a clone of the existing protocols and so on and so forth, why is it adding any value? It doesn't have the network strength, participation, liquidity that you could argue is what drives value into, say, Bitcoin. Or it doesn't have any of the kind of underlying ecosystem of Ethereum, and it doesn't have really any of the solid ability to build applications on top of like EOS.io. So you step back and look at that, and that's a fundamental irrational mispricing by the market, which is a classic sign of bubble activity. But it's also a classic sign of new technology that's disruptive and people getting excited about it and not really knowing what the hell they're investing in. So, I think there's an element of speculative investment based on the greater bull hypothesis that people are buying these tokens expecting to find some idiot to sell them to an idiot in the future for a higher price. And then there's just a general misunderstanding about the technology. They want to get some crypto exposure. They don't really know what they're doing, and they're trying to pick something that will yield a good result. So, yeah, there's some parallels definitely with the dot-com boom and bust in that regard. And I think what we'll see in the aftermath of the next cycle, where I don't think we're by any means at the top of this cycle, incidentally. I think we've probably got another year to 18 months before we hit another crypto peak. We will see a correction, but we'll also, I think, similarly, we're going to see those early Google, Amazon, Facebook type companies emerging out of that, and we already are in some cases, that are going to become absolutely dominant in this new era of digital assets.
Yes, that completely makes sense, and I love your explanation on that. I mean, earlier you had mentioned Binance doing the tokenized stocks, and I think if I recall, correct me if I'm wrong, that recently they decided to stop that,
Yep.
right? And it could be because of the being regulated. And, we're seeing a lot of media attention lately. I mean, I just saw, for example, CNBC talking about the stability of Tether, which is supposed to be tied to the fiat currency of the US dollar, and how they're utilizing commercial paper to do that aspect, but they haven't conducted an audit, which they've promised and such. And then this kind of whole DeFi space, decentralized finance space. Can you explain really that concept of what DeFi really is? And, is that something, if it's decentralized with these are these audits supposed to be mandatory? If it's decentralized, how is that supposed to work really?
Well, firstly, a good question to ask is Tether actually decentralized? And I would argue no, it's not. It's a fairly centralized structure that's operated effectively by the Bitfinex team as well. I believe they've got a lot of overlap there. Now, they have been relatively transparent in recent months and years regarding the structure of this. And they have at least disclosed the underlying backing of this, so commercial paper being a big part of what it's backed by, as well as a certain proportion is crypto-based assets. Some of it is indeed fiat. But that doesn't satisfy some people who will then go, well, look, this thing should be 100% backed one-to-one to the US dollar. The flip side of this is you can argue that nor is the existing financial fiat system backed by anything meaningful either, right? So there are ways to look at this. In one sense, it's an amusing example of the fact that, the critics of Tether are infuriated at its success because they can't understand why there is confidence in it. But what they don't seem to understand is you could argue that why is there confidence in really most of the fiat currencies when we've been printing a third of the world's US dollars? You can say, well, it's backed by the US economy and the US government, so there's backing there. But actually, the Tether stablecoin as the innovator in the system has actually quite successfully operated through some massive market volatility. And therefore, when you look at it as a store of stable value, it's not really that outrageous in terms of its structure and design compared to the fiat system itself. The fact that they are choosing not to go, a much higher proportion backed by fiat, I think is a shame, because that does always and will lead to persistent questions related to its kind of ability to remain completely safe, as it were, for people. You could argue there's a structural risk there, but what we're also seeing is a massive growth of other stable tokens that are applying the same underlying principles, but with different, different levels of structuring. So less commercial paper. And the USDC, which is the Coinbase one, is another big example of that. And there's another one called UST, which I believe is fully crypto-backed. And that's, another interesting concept. Go for a fully crypto-backed stable token when you think about how volatile crypto itself can be is an example of where we get to the DeFi system part of the question, which is what is DeFi? How sustainable are some of these ecosystems we're seeing built out? And indeed, what are some of these ecosystems in general? Because they're quite diverse. You can argue they're quite innovative, but they've also got some very strange concepts that for people in the financial services sector who come from it kind of look at and scratch their head and go, what exactly is this, that's being created? So if I'll touch on that, but feel free to interject if you wish. Decentralized finance, DeFi. What we're seeing is large numbers of blockchain infrastructures being deployed whereby you're seeing effectively financial services of different sorts being deployed on them. But really, if you actually look under the hood of what's driving this, they are inflationary schemes that are being dreamt up around the token economics, tokenomic modeling. So in most cases, you're seeing investors going in on the promise of yield. But what is actually driving the yield? Is it some sort of economic value that's being driving the yield? So is it like, for example, if we were to provide liquidity services to a commercial marketplace, so they're paying you a proportion of the economically generated profits to service the market? No, they're not. So what are they doing? Well, they're usually saying we'll issue 10, 20% inflation a year, and you get that yield for locking your value in with us. And then they're saying things like, well, now what you can do is we'll collateralize that capital that's locked in the system, and we'll enable other people to borrow for other types of things like farming schemes, which is another form of yield and so on. It becomes a kind of circular scheme whereby more and more of these tokens are just being issued out. And what's driving it in right now is greed and speculation. But what's eventually inevitably going to happen with those schemes, if they cease to be the ones offering the highest yield, is logically they will see some sort of major correction. And given that they're highly inflationary and there isn't a lot else underlying it by way of real economic activity, those types of models will probably collapse in the next crypto correction. And what we'll see from that is probably a reevaluation of the DeFi system like that to something hopefully more sustainable, where we see less of this kind of experimentation, which is just largely trying out token models and seeing what happens and so on. And we'll actually start to see meaningful, useful services. So I'll give you an example of a really good, valid DeFi project, and that's Nexus Mutual. So Nexus Mutual operates on the Ethereum blockchain, and it provides a decentralized insurance governance model. And it provides smart contract insurance to DeFi companies on the Ethereum blockchain. Now, it needs to do that because Ethereum is so immutable that if there's a exploit discovered in the smart contract, they can be hacked and you can see the users losing large amounts of money. So there's a defined need for insurance products. They're a great example for me of a DeFi company that's offering a real value and a real service, and an economic service. They're making good money, and they're offering a valuable service. But for every one of them, there's probably 20 or 30 of these types of DeFi platforms that are kind of arguably offering tenuous to little value in terms of actual economic value at this stage.
Okay. And I mean, from what I've heard, in the layman's terms, or what I've heard from the general public, is and correct this if I'm misinterpreting what I've heard from, let's call it the general public, right? Those not typically really ingrained in the crypto space, is the attractiveness of the DeFi space is well, it's decentralized and there's no centralized hub. But I mean, you touched base earlier on it that eventually, I think Antone can agree on this as well, like no government will allow a sort of decentralized system to essentially take over completely a fiat currency, right? Essentially, regulation will have to come into play. That's been a major component of most of this conversation of the technology is great. It has a lot of potential use cases, but there does need to be some regulation and compliance in play. Does it sound about right?
It does. I think there's something really, really powerful, though, about the ideology behind Bitcoin itself, which is, if we look historically, it's really only been in the last 100, 200 years that the government or governments globally have controlled the money supply, or what we deem to be money. You know, we for thousands of years prior, we were trading directly forms of asset-backed commodities as money, gold being the obvious example, and that wasn't controlled by government at all. And you have to look at the way governments typically behave globally, both in terms of it goes back to this point I made about centralization of power. What does centralization of instilled power over time typically also lead to? And that the answer is corruption. We've seen it, over thousands of years of history. It typically happens, human corruption instilled in institutions. And if you therefore give them full control, unfettered control over the money supply, well, then you see things like what happened in 2008-9, right? Which is that ultimately, when there should have been a number of banks that were left to rot and fail, they were bailed out with taxpayers' money, and ultimately, some of the poorest in society paid the highest cost. Now, we could debate all day some of the aspects of this, but I do think there's a lot to be said for this concept that there is more of a control over the what we define to be money. And actually, I think crypto itself redefines in some senses what money and stores of value actually are. And it has the potential instead to enable all of us to become our own issuers of value. So as an example, you can run a fund or a company. You should be able to issue out your own securities extremely cheaply in that company. And you should be able to operate a marketplace too if you want on that. And you shouldn't have to ask for permission to do that. You might have to obey a certain set of rules on that, and that's fine. But really, in democratizing that access and opening that up is for me a really powerful part of this. And then the other side to it relates to custody, which is it unreasonable for people to be the complete custodians of their own assets? I don't think it is. I mean, an interesting example of this is a Brit who's now US resident is the concept of the US government have the concept that they can just go into your bank account and take money out, which Americans might think is the most normal thing in the world, but I assure you it's not. In the UK, if the government decide that you owe them money, they can't take the money out of your account. That's not legal. They have to go through a due process to try and actually win that, and etc. They can't just literally go into your account, take the money, and say good luck getting it back off us, even if we've made a mistake. So I think it's a good illustration there of differing standards, and people globally should question what is an appropriate level of control for government around money and so on and so forth, and what is not. My view is that we'll find a healthy balance between all of this. There needs to be controls, but I do think that we've seen some fairly grotesque mismanagement of money, really in our lifetimes over the last 30 to 40 years, and it's led to a kicking of the can down the road with regards to a lot of this. And I think we're probably going to see some sort of incredible point where the financial system hits a point of debt that probably needs some form of effective reset. And we've seen that before historically as well, back in the back end of the 19th century. So this is not entirely new. But when that happens, this is where we will see an interesting interjection between, should we say, tokenized government money and the DeFi space itself. And we may find that it does become some sort of unstoppable force to some degree that people just cannot be stopped from using decentralized systems as ways of storing value. We'll see. It's going to be interesting.
See, David, this is where you're speaking my language right here, right now. I think we need to make you a permanent guest on this podcast. This is so what you just said. I think is wholly relevant, and I think it's important for people to hear. And I've talked with AJ about this before, because on the one hand, right, why does the crypto space exist in the first place? It's because people are losing faith in governments' abilities and just their actions of how they are managing currency and certain economic actions. You mentioned one of them being the bailing out of the banks, right? And so you just that inflationary aspect, people are looking for alternatives. And when you look at the crypto space, though, you have certain currencies that use, as you mentioned, they don't have a use. There's nothing behind it. And so that's where, for me, when I'm looking at, okay, the crypto space, it's kind of a threading of the needle, because I think if you're talking just, hey, I want to just create a currency and I'm just going to make it up on my own, if there's nothing backing it, what makes that any better than what some of these governments are doing? For me personally, nothing. And that's where, when I look around in this space, I want to see the use behind the coin or the technology itself. And I think that's where, for your company, Chintai, comes into play. And I think, if you could touch a little bit on how you see Chintai, how it differentiates itself from, some of these other areas, because I'm sorry, I'm going a little long here, but I think that's a big difference, because when I look at a lot of these cryptos, I think some of them also they're creating the crypto, and then they're basically saying to the markets and the financial industry, okay, use me. I haven't figured out how to use a use for myself, so you need to figure out how I can be of use. Whereas instead of saying, okay, here's an existing industry, how can I improve the existing industry, maybe change it, but still fit in the framework? I think that's a clear distinction.
Totally, yeah, no, absolutely. And you raise a really interesting point around these tokens that are created that don't necessarily have any obvious utility. I suppose you could argue that if you look at fiat as a general system, we could all quite happily, in theory, be operating off a single global currency, right? There's nothing to actually stop that concept in theory, but we do have replications. But then you can look at the specifics around that and say, well, actually, no, that's because people utilize money very differently. The economies therefore need more regional currencies because they reflect regional economic policies. And that could be things like tax rates, regulation, and investment and innovation, and so on and so forth. So there it's justifiable. Then you have to take a look at, you're right, there are a multitude of Bitcoin clones. An example being Litecoin. What does Litecoin really offer that Bitcoin doesn't? It's a great question. Despite its very high valuation still. Not a lot, really, right? I mean, it's, ultimately a lot of the underlying miners can happily mine on both chains. And so, I think you're raising a very valid point here, which relates to generally tokenomic design. And so certainly when you look at the design of tokens in general, they have to be thought through very, very carefully and be prepared to be adapted somewhat in response to time as well, because it's a lot of them have not been designed, I think, with a particularly strong understanding of economics. So the vast majority now are highly inflationary as the reward mechanism. And I really don't understand how that anybody who's rational can view that as anything more than a bit like the government. They're taking money out of your wallet and then giving it back to you and saying, here you go, if you stake. And that's largely what a lot of these models are based upon. So then if you look at the underlying other value side to this, which is demand and what drives it, in many cases that's linked to usage of the underlying network or the application itself in some form. That definitely has much more of a reasonable value proposition. So if we take Chintai itself, we issued a network token called Checks, which incidentally is listed on Bitfinex. So I talk, and I should say in terms of talking down Tether, obviously I have a good relationship with Bitfinex. I think they're a very, very good top 5 global exchange. But in terms of the Checks token, why don't we step back and ask what it does as an interesting example of how a token can fit into a commercial product and package. The token is designed to be a highly liquid external facing token that's listed on a wide range of exchanges and a wide range of different blockchain protocols. So it's an access token that enables people to get in and out of the network. And then you have to ask, well, okay, right, now what else does it do and why? Every single client that we onboard onto the network in different forms ultimately drives demand outwards for the CHEX token. And what that translates into is the underlying network fees and other types of associated commercial activity, providing forms of reward for the CHEX holders. How they choose to actually realize those rewards is very much down to, or will be down to, the underlying holders themselves, because that can lead to taxable events and so on and so forth. But outside of that, then, if we look at more complex token economic modeling, it's much more advantageous to have multiple tokens across a network, because you can embed different properties in them for different purposes, and you can incentivize different types of network activity. So I don't want to kind of go maybe into too technical a level on this, but that's one of the reasons why the Chintai network itself, ahead of launch, CHEX holders will be able to, from this summer onwards, be getting a range of additional network tokens that will be in readiness for the network launch itself, open to the DeFi side of the network and the public. And that's very much going to be geared towards aspects like liquidity provision, collateralization, and other services that we believe will be able to service the global financial system in controlled ways for the first time, as opposed to this side that Antone in particular has been talking about, which is the DeFi system itself, which is really not fit for purpose in terms of being able to operate regulated markets and regulated assets.
Mm-hmm. Because I think too, one thing that I noticed last week, and I don't know if either of you saw it, but Jerome Powell, the Fed president, was testifying before Congress, and he made a point about, the Fed can create its own currency and its own digital, basically crypto. And I thought that spoke to the disconnect that even at the highest levels, people still don't understand. The whole reason people got into the crypto space is because they don't trust you guys to what you're doing. It's not, they don't want to give you that power. But at the same time, how are we going to improve the financial space? Like you said, if you're connected to this network, I think that makes a difference in that use.
Yeah, and it's an interesting one. I mean, ultimately, the crypto space has had a choice up until now. It can either innovate without any concern for the regulators or consequence, and stick two fingers up at the global financial system, frankly, and say, we couldn't care less, you can't stop us. And there were a number of cases where people have tried that. I mean, a good example is BitMEX, which, for those not familiar, for years was the largest crypto exchange globally, and it handled Bitcoin futures in particular. And it introduced some fairly outrageous concepts like 100x leverage, which basically meant that a highly controlled, manipulated market would suck in retail investors who would put half a Bitcoin down, 100x leverage, they'd get instantly wiped and could buy half a Bitcoin or whatever. Actually, I think I tried this out for a bit of fun, lost a couple of Bitcoin back in 2016 on it, just trying it out, just to see what happened. Point is, that kind of model is not sustainable long term, and the founders of BitMEX have both surrendered to the US authorities in recent months because they finally caught up with them, and they've had enough of being ignored and effectively taunted in the press by people who are effectively trying to imply that they are above the law or above regulation. And we can take a look at other examples. Binance have similarly seemed to have painted something of a target on their back. Probably again because they're not particularly interested in that. But the alternative to that is actually that you can be respectful of regulators and understand that they're trying to fill a valid role, engage with them and help shape their policy thinking. What the approach we've been taking from day one. It's not to say that regulators are not perfect. They have individuals in there who are knowledgeable, but they're also learning as we're all learning. And they benefit from learning and being given good information about what you're proposing. So as an example, when we deploy out this sort of walled rose garden upon which these regulated markets can operate, and there's going to be controls over who can participate in regulated digital asset issuances and secondary marketplaces. On the other side, you've got the DeFi space, and we have built a regulatory bridge where we can control that interaction between the two. Now, some regulators might say, listen, we don't want DeFi providing any liquidity to your marketplaces, even though it's going to be via a regulated participant doing that. You'll have other regulators who say, actually, that's an entirely reasonable use case for it. It's very controlled. It could actually add a ton of value, and it could provide much cheaper liquidity to all these industries. We're happy with that. And it's over time that we'll find what is acceptable to the regulators and what's not. But again, by enabling a solution that actually can fit with whatever they decide, you end up with a more harmonious relationship. And that's where I hope to see a harmonious relationship form between the traditional finance industry that as it moves to digital assets and true DeFi, where obviously everything's completely unregulated and decentralized. And I think what we'll end up finding is that bulk of the economic activity operates in these what is currently traditional finance, but in a digital form. And we see some long-term use cases from the true DeFi space too. And really beyond that, it's very hard for any of us to predict how this is going to play out. I think it's rather like looking back at sort of 1997 and saying you could foresee Amazon Web Services and social media and everything we've seen in recent years with Uber and so on and so forth. I think it's all we can do is say that there's going to be a high level of disruption, and we'll see some fascinating use cases start to probably evolve out of this that fundamentally change the business model.
Yeah, and so David, I mean, we've touched on it, throughout the podcast, but I do want to make sure we do cover it, as you are the CEO. Can you just explain, I guess, your guys' pitch and what the Chintai platform is and the mission, I guess, you guys have working with this space?
The mission itself is quite straightforward. We want to completely open up access to this concept of issuing digital assets and operating liquid secondary markets to everybody over time. And I even mean down to the individual level eventually. Now, this raises an interesting question, which is if anybody can issue a token and it has no actual underlying value, you're issuing, let's be fair, the classic shitcoin that has no actual underlying value. So there have to be limitations on this, right? It has to be a valid proposition in some form. But if you're an artist, for example, what's to say that you issuing an NFT of your artwork in some form is not valid? Value is such a subjective thing. So ultimately, that is the aim. But in the immediate term, what we are doing is deploying a platform, the beta program, private industry beta program, which launches on July 31st. So we're excited to kick that off. And it's about integrating the issuance and secondary market functions into a fully integrated suite for the first time. We're not interested in becoming some sort of centralized marketplace like an eBay of digital assets. There are a lot of players out there you'll see, and that seems to be what they're trying to do, which goes to us completely counter to how to build a really powerful, productive, harmonious relationship with the industry long term. What we're doing instead is providing a tech solution, software as a service, if you like, to as wide a range of institutions as possible. Now, some of them can leverage us directly with our branding and with our licensing, and for them, it's going to be the obvious way to go forwards. But for a lot of others, they're going to want to build lines out for themselves, facing their own client bases. And there, they get to just leverage the platform. They can issue out dynamic forms of securities, real estate, bonds, other forms of debt, and in theory, over time, it'll be NFTs as well. And they can decide the types of marketplace they want to deploy in theory as well, or they can utilize an existing market operator and list there instead. And with that comes this concept of automated market making. And what we've got that's, I think, quite different is we have true one-sided liquidity provision, which is, for those not familiar, it removes this kind of concept of just impermanent loss and introduces another concept called impermanent gain, which you can get on both sides. That's going to, I think, fundamentally change the dynamic of liquidity provision and how it works. And it will actually act as quite a powerful signal for asset pricing as well. So, but whereby liquidity providers will play a role in deciding whether or not they think assets become irrationally valued. And they may choose to lock in an impermanent gain and take their liquidity out of the market, for example, in a certain scenario, and they will go back in other scenarios as well. It's going to, I think, fundamentally change certain things like that. But the other big core part of this is operating on a permission blockchain for the first time. And what that really means is that we'll have a compliance control framework that people can choose to subscribe to for a given jurisdiction, like, say, Singapore or the US. And when they deploy those marketplaces or they carry out an issuance, they can also restrict which kind of types of investors based on their geography and the KYC AML process, the onboarding process they've gone through. They can basically operate a fully licensed and regulatory compliant marketplace. And that, for me, is going to be the most exciting thing that we see with the platform launching, is that we've really got a solution here that industry need, and it's going to enable digital assets to be deployed actively this year. It's not, yet another year of us sort of talking about when will mass adoption happen and when are we actually going to see some meaningful issuances. In my view, the year is 2021, and it's going to start happening in the next 6 months.
Yeah, and full disclosure to everyone listening, before I forget to talk about this, Antone and myself, as well as Chimera Wealth, are investors with Chintai, and have partnered with them because we too ourselves, right, are very excited just having all three of us here having that background in the traditional financial space, the operational component, and how there are those kind of inefficiencies. I'm really excited to see, how the technology that you guys have developed will impact, because I think it will itself impact the industry as a whole for the better. I'm really excited for that data to
I totally
launch.
agree with you. And I mean, just to give an illustration of the variety of this, we talked a lot about the existing DeFi space, and we talked about securities, real estate. But another use case that's being driven in, even in this beta stage, is an example, which I think really shows how diverse digital assets can be. A company is handling this concept of called blue carbon, which, for those not familiar, relates to carbon that can be trapped rather than growing trees through seaweed, which grows 1,000 times faster, and enables vastly more carbon to actually be stored in a secure way for hundreds of years and effectively trapped and removed. It enables then that to be tokenized through a backing mechanism, and then in theory you can have a liquid secondary market. Now, in that particular case, they're talking about governments being involved already with them and hundreds of millions of dollars of initial capital going into that marketplace. I only bring it up just to illustrate something I find fascinating, which is just how diverse use cases can be, way beyond just the traditional financial products we're talking about. Digital assets and tokenization really can encompass almost any of these types of industry scenarios too. And that's where it gets interesting. That's where, as well, it gets particularly interesting with things like real estate as well. Because not only can you fractionalize real estate and add liquidity to a really illiquid asset class for the first time, but you can embed other properties like the ability to timeshare. You could tokenize commercial real estate and actually enable its usage to be kind of converted in different forms, or the way that we currently have WeWork for kind of flexible usage. You could see whole swathes of commercial real estate no longer being used due to the pandemic, being repurposed and utilized in some form of tokenized, issuance platform that enables that too. So all of these types of things get enabled, and it goes back to what I was saying, that we're going to enter this period of innovation, I think, where people are going to come along with business ideas and say, great, we can utilize Chintai for this purpose, for the ongoing issuance, the compliance, and the trading functions under the hood. And then we've got this whole other business that's doing something really unique and disruptive. And the end users aren't even going to know they're utilizing Chintai in any capacity in that scenario, but they're going to be utilizing an incredible platform that's doing something really different and disrupting a whole sector.
So I think one thing, I had two questions on that. See, earlier you said that you're not trying to be the eBay of, like creating the marketplace. It sounded like to me, because think of me as the layman who's not, because I have been a little bit more cautious when it comes to the crypto space. So to me, it sounded like you were describing kind of what Bill Gates did with Microsoft, where he was saying, "Hey, we're not trying to build and sell IBM the Microsoft suite. We're going to license, we're going to partner with these hardware firms. Would you say that that's an accurate kind of description or like a analogy, I guess, of in a way?
It's not a million miles off. Yeah, in the sense that what we're trying to do is obviously onboard as many onto the network as possible to benefit from the cross-network effects that they'll get from that. But we are ultimately, we're providing a software solution that we want to keep really harmonized with our partners and dynamically enhanced based on their feedback, continuous innovation, and so on and so forth. I guess the one thing I'm not comfortable with that analogy is the fact that Microsoft became a hideously anti-competitive and a monopoly, and we have no interest in becoming that.
Right.
So I guess if you look at the financial services equivalent, I look back and it's littered with some firms that almost got too dominant. Bloomberg is a great example, and the amount they've been charging for data for years, for clean data, particularly instrument data. And then you could look at the role of, say, Swift within the global financial system. Prohibitively expensive, it's underinvested, it's underperformed. In all these types of cases, what you end up doing is incentivizing the industry participants to bypass them any way they can and invest hard to build an alternative solution. So I would far rather we had a harmonious relationship with our client base, ultimately, whereby we're there to support them, we're there to enable innovation, and we're there to enable them to deploy out lots of competing marketplaces and solutions and so on and so forth. And that's another reason why we've got some quite clear limits on the network as to what we're going to try and provide. But, take custodial solutions. There's a definite need for high-quality custodial solutions. Well, we could do that ourselves. I'd prefer to have a multitude of custodial providers and KYC, AML providers, and really let the clients on the network pick and choose the very best. And that really goes right down to the modular design of what we're building ourselves, which is they might want to, in theory, just deploy on the network itself and bypass every facet of the Chintai platform. So not utilize it for issuance, not utilize it for market making, and not even, in theory, utilize the compliance control framework, although good luck then trying to enforce compliance. I don't know how they do that, but they could, in theory, try. And they could build their own rival exchange or issuance platform, or they could build their own alternative issuance platform that rivals it, and maybe it'll be better. And that kind of competition is just generally very, very healthy for the industry. And again, it really, for us, we benefit regardless of the network effects. So it's about trying to capitalize on that as well. And by doing that, you're not going to do that if you sit there and go up to a bank and say, come and deploy on our exchange or our branded marketplace, because they're going to look at that and say, well, why would I want to become overly dependent on you in this early, stage of technology?
Right.
This is why some of the earliest discussions, we've already been in discussions with some of the largest financial institutions and banks globally and had an extremely positive response from a number of them. Way more positive than I was expecting, actually. It's tremendous. And in a few cases, one of the questions that's come from them is, how do we migrate digital assets from another protocol to you? What would be the process for that? And also, in theory, what's the process for migrating off you later on? And that's a very, very good question and a very valid concern, because anybody utilizing any technical solution in digital assets right now should not be building some sort of critical dependency on any provider long term. They should have that right, in my view, to move technical providers and move those digital assets wherever they please and choose. And that's what's going to keep us lean, competitive, innovative, and hungry, is that risk, And so I want to make sure that that's something that all the clients onboarding can do as well. It might sound counterintuitive, but I think strategically, long term, it's by far the best thing, which is to keep your interests super aligned with your clients and customers.
Yeah. Well, and that I think is good to hear. I think that's probably why you kind of labeled it more as like a tech support, and you want it because you do want that competition. You do want that partnership with people that you're working with. I guess one question I do have as well, and I think you mentioned one already. And when you've described what you're trying to do, I've been kind of thinking to myself, okay, how would this be used? How would I use it? What's the real world use? And you mentioned real estate already. are there three areas? Obviously, you said you want it to be broad. You want a broad use, but certain areas to implement the use might take a little more work and creativity than others. As you mentioned, some of these financial institutions have asked, how are we going to migrate some of these assets? But are there, let's say, maybe three areas that you think are kind of no-brainers because that the use should be the easiest and the most, the easiest decision to make the change to? Because I think of real estate, people purchase cars, so some of these purchases that people make that, can take a lot of paperwork, a lot of vetting, and just the process takes a long time. There should be ways that I think they could be more efficient. And we've already mentioned our industry of, just traditional investing. So are there three areas that you think are easier than others?
Definitely. Yeah. And there's also, it's not just three areas. It's what's the industry-led demand coming from? Because that's really obviously going to be one of the core drivers here. And by far the biggest is tokenized real estate. The ability to fractionalize real estate and actually add liquidity to it for the first time. I mean, if you look at the value of real estate, it's actually disproportionately low compared to things like bonds and securities. And yet it's this tangible asset-backed thing, which really should make it extremely valuable. So the question is, well, why is it undervalued? And for me, the single biggest thing is that it's highly illiquid, which makes it a very difficult thing to trade in and out of. I know we have REITs, real estate investment trusts, and other types of unitization of it. They're not really particularly accessible to the average investor. They're also not very dynamic, and they're quite expensive. So definitely real estate is one of the big things for us. And then outside of that, we also think securities and debt are going to be the other big.
So the point you just made about real estate, I think, is an interesting one because historically, real estate was the most valued asset in the world. It didn't matter where you were; real estate was the most valued asset in the world. And I kind of have a theory as to why that value relative to some of those other assets that you just mentioned has, I would say, relatively declined. And I think it coincides with the ease of, maybe not the ease, but the electronic aspect of transactions. And, now people go into the stock market. It's far easier to buy stocks and bonds today electronically than it was 100 years ago or 200 years ago. And there's more access to everyday people. But at the same time, the real estate process, like you said, is there's a lot of there's just a lot of work involved, and the process to buy real estate and have access to it, whether it's fractional, is just it's just hard. So that's where I think that makes a difference. But that, like you said, historically, real estate it was not undervalued. I think in that way.
Yeah, and so before we wrap up, David, we always like to give our guests, especially someone like you, as informed as you are, the last word on whatever you'd like to know. Where can people find more information about you and Chintai and the platform itself, and any last remarks that you have for the audience?
Yeah, well, firstly, we should probably spell it right. Chintai means lease in Japanese for those curious, because our first use case was leasing, and it was a bit of a nod to Satoshi and the whole Japanese pseudonymous identity thing. But to find out more about us, www.chintai.io or at Chintai Network on Twitter as well. And in terms of, parting kind of ending remarks on this, generally, been great to have a free-flowing conversation on all of this and the evolution of the systems, some of the challenges we're going to see, and I think some of the future direction of both Chintai as a platform and the general digital asset sector. For me, I think the only parting remark I would say is that for anybody listening who's thinking of maybe getting into this space or wants to go the entrepreneurial route, that my takeaway as somebody who kind of went into this having shut down another business, exited that, and was really trying to decide what to do next, is that the biggest advice I can give people generally is to, frankly, start down a route and follow your passion and area of interest. And from that, if you come up with an idea that looks like it has real value, pursue that and start to pull together resources and people who are genuinely prepared to actually do work and work with you. And from that, you'll find, an initial team of people will come together. And even if they don't stay with you on longer term in the journey, things will flow from that. And that's definitely the story of Chintai. It started off as a completely organic community project where I just went out on Reddit of all places and asked if there were any developers interested because I was going to publish a white paper out with an idea. And, I found one or two developers I thought were, worth actually joining me. They're not still with us. But, from that, I found the CTO of the company. From that, I'm also being involved in the launch of a blockchain. I found the COO as well, and we all came together as a core team. So I think for people who sort of are maybe listening and thinking, I'd love to go the entrepreneurial route, I just don't know what to do, or I don't think I could do it. The big lesson for me from all of this is that you actually, if you get out there and put yourself out there and are prepared to put in sweat capital to just do something, you'll find there are a few others out there who do as well. And if you just don't accept no for an answer and just keep pushing, you will eventually get over the line and can achieve some impossible things. I remember people saying to me, I can't believe you've actually built a full exchange system on a blockchain within 2.5 months of the launch of this new protocol. They couldn't get their head around the fact I'd come up with an idea in February and by October this thing was live. And, it seemed almost impossible, right? We did it with almost no real funding. We did it with just some sweat capital of some passionate developers and myself and some others. But anything is possible. And then from that, you can look at it and say, well, how do you sort of get through a crypto winter with very little funding? You're prepared to make sacrifices, you can do that. And then you get out on the other side of a round where you close a $7.5 million funding round with some multi-billion-dollar backing and you can do it. But you have to just be, tenacious, not accept a no for an answer and genuinely be passionate about what you're doing. And so that's my parting thought really for anybody listening who thinks, I'd like to get into the digital asset space and do something, but I'm not sure what. I would say plunge in head first and stay open-minded, and you will find opportunities. You can create them.
That is great life advice in general. So I hope everyone listening, that's great.
Well, that's because I'm old, don't forget. 100% so I've got the age of wisdom on my side these days.
Hey, age, as I've learned throughout my lifetime, age is just a number. All right. I've been around and seeing people a lot older than me having a lot more energy and the ability to do things that I'll get there one day.
You'll get old one day, you mean.
Antone, you have anything less to say? Yeah, pretty much.
I've appreciated David joining us. I think it's good to hear his perspective on the crypto space in general. I mean, it's been very good because I haven't had exposure to much to the crypto space, but then a lot of times when you're talking to people, they just have this, raw mentality of I love crypto, just very crypto. And when I've always searched for, okay, well, what's the true purpose behind it beyond just, I'm creating a coin or I like this coin. And he has a company that I think he's created that is that he's trying to create a purpose in, but also add value to the economic activity. I think I like the perspective that he's brought to that.
We're going to have to bring you again. Definitely have you guest again.
A general discussion on things like NFTs and the wider crypto space. I'm always happy to give opinions if you're curious. So sure, love to.
Oh, perfect. Like I said, I love that you have that perspective, right, of both our kind of traditional area, but also in the more digitized, the up and coming space.
I have healthy cynicism of both sides. How's that?
Mm-hmm. Yeah. That's a good way to put it. All right. Well, everyone, till next time, you have a good one. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations on any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and the possible loss of principal capital. Please seek advice from a licensed professional.